Now we're going to turn to refined products and go through in more detail. What are we seeing in terms of imports, storage? What is the production look like? And again, we're going to really kind of dig into what are the demand drivers that we see going forward. And before we dig in, again, we'd like to remind you, please like, share, subscribe. And just a reminder, we do have our report, end of year report coming out, looking at the overarching oil field services. What do things look like, and then what are we expecting going forward? So, now that we've covered that, let's look at U.S. product supply. So this is just looking at kind of the main four drivers. Again, there was a decline last week. It was about 13.8 million barrels. Here it was at 13.4. So again, we saw that continuous decline that we were expecting, and just given some of the data points that we've seen on that high frequency side, daily activity side, it's going to continue to trend lower. But again, as we've been saying, it's just going to tighten up a little bit where we're going to start to kind of hang around between this 13, 14 million barrels and just go sideways as we head into the end of the year, just as we have additional cases rising. Like my wife just G-chatted me saying that there is another positive student at the school. So I think everyone is facing some of the similar issues. I think Rhode Island's at 9.2% infection rate. These are things that, again, not that we need a mandatory shutdown. It's just people are going to look at that, are going to see what's happening, and just and consumer behaviors are just going to shift. And these are things that we're going to continue to see over the coming weeks. Now, when we turn to distillate, we had a fairly large build, especially against what was expected. What was expected was a draw of about, let's call it 1.1 million. Here we have a build of 3.2. It was really kind of driven across the board. There were builds pretty much everywhere. The bigger aspect that we talked about last week and the week before was that we saw a big shift in terms of imports. So typically the normal flow is U.S. exports distillate to Europe and imports gasoline from Europe, and that's the normal flow. I mean, typically, things can shift if the numbers make sense, but because of the lockdowns in Europe, because of the overcapacity in Europe, we've seen a big increase with even Russian distillate heading to the East Coast or Pad 1. And those are things that are going to remain continuous, especially if we look at Pad 1, which had an increase of 404,000 barrels a day of imports. The yield, especially because we had a decline of about 50 basis points of utilization rates, the yield for distillate was slightly up. And it's just because we're starting to see refiners pivot more like they normally do, which is make as much distillate as possible at this time period. When you make diesel, you inherently make gasoline, so there's no way to get rid of that, but you can shrink that pool by adjusting some of the feedstock, going a little bit heavier, and readjusting to create a bigger pool of distillate. Now, when we look at storage, you can see it bounced up. We're still above that 30-year average. We're fairly in line with the 5-year average, so moving up isn't really that crazy when we're looking at it. The bigger issue is really coming into gasoline, because distillate does have some demand within the U.S., so this will be fairly supported, where gasoline we think is going to have a much harder time. Now, when we look at overall, demand, again, demand is just following the 5-year average. As we said, we had a request to look at this on the 5-year, just because it's a little bit lumpier. But again, you can see that we're just really tracking where things are. So we would expect to see that recovery into next week and really into the middle of December, just as people turn on their heat. The question is, how cold will it be? Right now it's not expected to be all that cold within the Northeast, with the South seeing a bit more cooler weather. And typically the South uses a bit more propane, which again speaks to some of the strength in the LPG market. Now, just looking at some of the quick demand hitters, here we have the truck stop data on market demand. It fell to 80. Again, if you remember, we're between 95 and 105. This is more of a holiday drop than it is anything else. It's not something where we see this as a continuous pressure and slowly moving down, especially as we have, which we'll talk about in the Econ show, we do have an increase in PMI. We do have an increase in new orders. We do have an increase in exports, which again is going, or I should say, say export orders, which is going to support trucking demand. So this is something that we expect to see a quick bounce back. And if we don't, then we're really going to have to start saying, okay, well, are we past the hump and now we're starting to normalize a bit? Or is it something where it's going to remain elevated? Here you can see truck availability dropped. And again, this is coming full circle to why we think there's going to be a turnaround, is truck availability drop, load availability drop. So people, and if you just look at the activity from May to October, some of these drivers were definitely ready to have a break, have a holiday. So there's nothing to say that we're not going to see that reverse, especially as we have rates continuing to remain elevated and shift higher on a refrigerated, flat, specialized. Pretty much any rate we look at is either flat to up, and it's not really driven by diesel prices increasing. It's really driven just based on sheer demand. So on the rail side, total car loads were down 4.1%. That continues to shift lower. And it's one that's going to remain under pressure. And as we've been saying, grains bounced from last week, but still down from the week prior. Grains and farm products are still going to outpace 2019, but they're going to continue to underperform week over week. Just as, again, we're past harvest, where some of the exports are starting to get filled up. Or I should say export orders, but some of it more for January and February. So there's going to continue to be some pressure on that. And then the metallics, motor, non-metallic, petroleum, those are ones that we think are going to continue to be headwinds over 2019, especially on the petroleum side, which is going to continue just given what we, when we look at activity, and as we talk about in our Friday show, activity is really being driven a lot more by Texas and less by the Bakken. And the Bakken is where we see a lot of that petroleum and petroleum products. Then when we turn to a bit deeper on the petroleum product side, when we look at just demand numbers, the demand continues to underwhelm, which again just means that we need less tankers to move product around. Intermodal remains robust, and it's something where, again, these are long hauls, so these can remain elevated for an extended period of time and then drop off fairly quickly. And this is one that we continue to see fall off a little bit. Intermodal, it remains strong though, which is again a positive for the rails, a positive for movement when we're looking at general economic activity, which on a PMI level is being supported, and you're seeing it in the intermodal units, and intermodal is really carrying that total traffic, which again was up 3.7%. Still down year to date 8.3%, but again, slowly starting to eat away at some of those declines and setting up for a fairly strong start to 2021, at least on the intermodal side, as we start to see things shifting around. Now, when we shift focus and look at gasoline, here you can see that we had a build of about 3.5 million barrels. It's pretty broad. Pad 5 had a small draw of 680,000, but with Newsom implementing some tighter restrictions on stay-at-home orders and other types of problems that are continuing to hit some big driving areas, specifically Pad 5. Those are things that are going to continue to eat into some of those stock draws. Now, just to give you an idea, we normally build, so the expectation was about 1.6 million barrel increase. And if you just look at this chart here, you can see that we normally go up like this. So we're doing what we normally do seasonally. It's just we're doing it from an elevated level at a faster clip. If you look at just where we're starting, how the builds are increasing, and the pace. So the slope is really holding the slope from that we normally see from the end of November into December. It's just it's an elevated level. And the problem is the demand's going to remain a problem, just as we'll talk about in a few minutes. But we will continue to get more imports, as we do have additional imports coming in from Europe. And not only that, in terms of what we're seeing from imports, but there's also an issue on the Rhine River, where the Rhine River is falling to near historic lows, and there's going to be difficulty moving stuff around within Europe, which just means that there's going to be product that's going to be stranded in different locations, which we could see increase or at least push additional gasoline into our market. And it'll be interesting. It's something to watch just because it might adjust some of the runs within Europe, which may put more imports on the water. It could take some off. But again, this is something where just over the next 2 weeks, we continue to see imports coming across the Atlantic. Now, as imports come across, demand continues to fall. And this is something that we've been talking about where we were expecting, lower highs, lower lows, and here we see another lower low. We were hopeful, and this is coming from someone who shades a bit bearish just based on our views on the global economy and just general demand. We were expecting a little bit of an increase in driving just as people avoided trains and avoided some airlines. Instead, we saw a big drop across the board, and this is actually going to get worse just based on the data that we've seen on some of the other sides, which will send this a little bit lower and make another lower low. And again, just based on the cases, the problems that we're seeing, there's nothing to say that we're going to get this big snapback. If anything, we'll continue lower and then just go sideways really into year end. Now, when we look into the Google data, what does Google tell us? And you can see that there was a big drop. Not surprising. And it's not surprising just because, if you drive around, I think on average, 78% of businesses are closed for Thanksgiving. And a lot of people were doing Black Friday sales either that whole week or expanding it into the month of December. So there was really no rush to get out on Black Friday. And so that also ate into travel. Now, with the increase in COVID cases, we're seeing less and less people going to work. So we're just assuming that some of these declines, while they are seasonal with obviously Thanksgiving, when they do snap back, they're going to settle out at a lower normal and continue to roll over a bit, especially into year end, just as people do less to minimize exposure ahead of Christmas. Now, when we look at Apple mobility data, it's saying something very similar. The U.S. is now negative 2%. Germany's down 12%. U.K. down 20%. Italy remaining down about 37%. These are things that are going to continue. There's nothing to say that they won't. Again, as we've said before, they're not going to get to the levels we saw in April, but we just don't see the same type of recovery, especially as people try to minimize. If you do plan on seeing family, why would you risk exposure? And if you did see family on Thanksgiving, maybe now you're quarantining just to make sure that you don't continue the spread. Again, all of these things are going to eat into U.S. numbers. Now, Germany has extended their restaurant and store closures through January. We're seeing some of that continue throughout Europe, even though they are on the other side of increases in cases. But again, these are things that are just going to continue to weigh on general demand. So this is the weekly gasoline demand numbers from Gas Buddy. Last week we were down 7.3%. Now, for anyone that knows the EIA numbers stop at 1127. So when we look at 1127 and we adjust for that, technically Gas Buddy data is down 6.2%. So it just shows just how weak things were, continuing, which is already putting a headwind into this week as we look out in terms of where demand is. And when we look at the numbers from the EIA, they're showing a fall of about 1.9%, with Gas Buddy showing a fall of 6.2%. Descartes Lab showing a fall between 6 and 7%, pretty much in line where Gas Buddy is. So again, that's why we expect additional pressure with the EIA numbers. These are problems, and just to give a backdrop of just how bad they were on a year-over-year level. So Wednesday was down 38%, and this was last week going into Thanksgiving. So Wednesday was down 38% year over year. Thursday, Thanksgiving, was down 32% year over year. Friday was down 23%. Saturday was down 26% year over year. So you're getting an idea of just how impactful, COVID has been on typically a little bright spot that we normally see heading into Thanksgiving. Now, COVID net changes. The U.S. remains elevated. Nothing to, I don't think anyone's really surprised, especially because there was a big rush to get tested ahead of Thanksgiving, and we're still trying to work through some of that backlog. The ones that we want to point out because they remain a problem for where we think demand is going to go is really India. India is starting to see an increase in cases, again, coming to an issue with reporting, as some of it is being merged. But when we look at case counts and when we try to normalize the data, we are seeing an increase, which after festival season is a little concerning because, how many people are exposed? Is this going to be something that's going to continue? Worldwide, something similar, which is the worldwide levels in Africa are kind of following something a bit standard, and Africa is seeing that its own increases, but Europe is the one that we're continuing to watch because they have seen they have gotten ahead of some of the spread. When we look at road traffic and just focusing in a little bit more on Europe, you can see in terms of where things are on an aggregate basis, we're pretty much down anywhere between, let's call it 40 to 20 to 17%. Germany is slightly better, and it's really driven based on toll miles, and we are seeing some decent trucking numbers, which are helping to offset some of the lack of cars. So Germany on a car level is lower, but when we factor in all the other different in terms of just general road congestion, Germany does remain fairly strong, while the others continue to head in the wrong direction. France, Spain, Austria have started to normalize, and again, it's not that they're going to snap back. It's just we don't think they're going to continue to fall, and they're going to remain fairly stable at these levels into year end. And just to kind of highlight what we're talking about when we look at Germany, this is just a deeper snapshot on what's happening within Europe, within the UK, and you can see that heavy good vehicles are still moving along. Light commercial vehicles are still moving, better than most. But then obviously cars is the one where we're seeing the biggest backdrop. So Germany just has more heavy good vehicles and trucking, which is helping to kind of bridge that gap. But on a car level, they continue to move lower. And then all motor vehicles, you're just seeing that once you start to look at everything put together, they're down to about, let's call it, 77%. So they're off about 25% from normalized numbers in March, which is, again, looking at this from a global perspective on how gasoline demand is going to be hurt over the future. When we look at India, high frequency numbers, the ones that we wanted to point to were the new active cases. So you can see that they were pretty consistently going down, and now they slowed going down, and now they're actually starting to creep back up. The lockdown index has increased a little bit, and it's just, again, it's not a national thing. It's more about a local, provincial thing. So the lockdown index has started to rise. It's back to 60. I think it's back to about 63%. New active cases is the one to watch to see how tight will things get. And then when we look at power demand, congestion index, the congestion side continues to weaken, which again is what we keep looking at when we're talking about what is happening within India. Now, as we said last week, India gasoline demand remained fairly strong, but diesel demand did drop. So diesel was down about 7% year over year, still up month over month, but down 7% year over year after having a nice increase in October. And it's a mixture of a decline from the festival and just inherent pain that we're starting to see arise, and again, capping some of that growth that I think the market got a little ahead of itself on when we're looking at India. Looking at the U.S. in a bit more detail, you can see that things are worsening, especially on the new COVID cases. The new case, then not only just the cases but also the deaths, which is just going to increase the lockdown index. So you can see the lockdown index increase to about 75%. Based on what we're seeing, it's going to stay at about 75%. It's going to come down to when are people looking to. When are states going to do something similar, or will they try to avoid it? Again, that's why we think that maybe 80% makes sense, but it just means that there's going to be a just pressure on the overall driving schematic of just overall demand. Now that we touched on that, let's just look at total activity in developed markets. You can see that things continue to roll over, specifically in Italy and France. France, we thought things were getting a little bit better, and then they rolled over a bit. But again, they're kind of moving in a fair margin of error. And we think that things are just going to remain sideways, specifically in Italy, France. Germany will continue to get a little bit worse and work its way down just because they have extended their lockdowns, which again is just going to put additional pressure on the overall component. And this is something we'll talk more in the econ show, but you see all of these are rolling over really except Japan. And that's just essentially pulling all developed markets lower, which when we look at imports, when we look at global trade, when we look at the health of the global economy, this is going to be a big headwind. Shifting into jet fuel. Jet fuel had a small build of about 7,000 barrels, nothing crazy. When we look at airlines, as we talked about, we had the big spike as airlines, airports went out, purchased jet fuel, brought it into their airports, made sure that they were well situated for the holiday travel. Holiday travel had a nice little spike. I think we reached over 1 million passengers twice. And now things have slowed considerably now that things are getting back to normal. So we continue to expect, that a pretty steady decline just because there's just that demand has dropped off as we've seen flights pare back. This is just looking at TSA passengers. You can see that we hit that level twice heading into the week. And obviously, when we go back at last year, we had something very similar as people, normally drive, except last year it was closer to about almost 3 million. Here it got to about 1.2, 1.3. So again, you can kind of see the backdrop of the pressure. Now we're at about 780,000 passengers. We think again it's going to be between that 550, 850, and just we're going to work within that. There's nothing to say one way or the other, especially as cases get worse and people start to shy away from airports and just airplanes in general. And that's when we look at the BNEF data that they do a great job collecting. There's about 870 fewer departures week on week as the holiday ends. So you can see, obviously, it's all driven based on the U.S. We'll see some of that come back as we head into Christmas, but Christmas isn't the same travel that Thanksgiving is, and especially as cases get worse heading into Christmas. I know anecdotally, people that have canceled their flights for Christmas just due to the increase in cases. So I think that's something to watch, especially as we go into the remainder of the year. Looking at OpenTable, just because it's a good gauge to see how interactive are people really being. On a global level, again, as we said, lower highs, lower lows. It's something that we think is going to remain under pressure. We were expecting a little bit of an increase, or at least a bit more of a stabilizing capacity, but then Germany came out and extended their lockdown through January, which is going to put some pressure on where we thought some of the recovery was going to come from. Now, when we say that, when we look at the regional breakdown, you can see on a global level, we're right around that 55 to 65% decline. Australia remains zero spread, zero new cases, so that's a positive. That will see some activity. But again, Germany with the full-on lockdown, Ireland something similar. Mexico is. That's a COVID thing, but that's also a really big problem on a economic level as a lot of their numbers and leading indicators continue to worsen. UK is starting to lighten up a little bit. They've now taken away the national lockdown. Made it more on a city provisional level. So that's something that's going to get a little bit better. The US is one where we think there's going to be a continuous slowdown, weather-driven, COVID-driven, and these are things that are going to weigh on just total activity. Now, wrapping up, as we'll talk about more on the econ show, we're seeing less and less people going to the office again, and it's just people looking to avoid exposures, getting colder, trying to avoid some of those different impacts, and you're starting to see that rollover. So obviously, Thanksgiving, people don't go to the office, especially even those who were. But you're kind of seeing that steady, gradual decline. And when we look at the 7-day moving average, we're down to about 1.3. And it's the same type thing where obviously you had Thanksgiving, but even on the bounce back, we're not going to get back to those highs. we're going to see a continuous drift lower. And more cities are showing something similar. And we have other charts that we'll talk about in the econ show that kind of bring this all together, showing the pressure. And again, it just comes down to spending, tax revenue, businesses, how many closures, general activity that is just going to be damaging to not only oil demand, but also refined product demand.